Hello, I'm Andrew with Jesani Wealth Management, and I want to discuss absolute return funds or hedge funds. Who's investing in hedge funds? Why? And do or can they play a role in a high net worth retail investor's portfolio? So the first question is who's typically investing in hedge funds? Historically, it's been the larger institutions. And when you look at who is actually outperforming the S&P 500 on a consistent basis, we all know that retail investors, unfortunately, do not. Most financial advisors or investment advisors do not. And believe it or not, 96% of mutual fund managers or fund managers do not outperform the benchmark that they're tied to. So who actually does outperform? And the answer to that is institutional investors. So that could be insurance companies, that could be pensions, or that could be endowments, as is the case of what's on the screen right now, which happens to be the Yale University Endowment. It's one of the largest in the U.S. They have about $42 billion right now in the endowment, and right here is how they allocate those assets. Now, we use all of these in our 3D asset allocation to create a lower level of correlation. Speaking of low asset correlation, it's really one of the primary characteristics of hedge funds, is to invest in other assets away from publicly traded equities or even away from equity with asset classes with low correlation to reduce drawdown potential or reduce volatility and have a more consistent positive return. So this over here is just another way to look at the Yale portfolio, absolute return, hedge funds. The names are really interchangeable, and I'll go through one moment why they're actually called that. It may be quite obvious, absolute return, but I'll walk through the difference between a hedge fund and let's say a mutual fund or any other fund that's tied to a benchmark. But I want to touch on the history of this particular endowment. And they actually any endowment that you look at is going to look really similar to this. And you can see that back in the 90s, they were investing this endowment primarily in publicly traded equities and fixed income, stocks and bonds, right? The dark blue section here is domestic equity, so U.S. stocks. The light blue is U.S. fixed income or bonds, and the red is international equities. So they used to have, just under 90% in those three categories alone. Of course, when public equity valuations were more attractive, fixed income was more attractive, but it's really had a significant shift over the last 20 years to now their allocation to domestic equity is only less than 3% exposure. Here it is right here. U.S. equity is 2.25%. This other illustration shows 2.3% in stocks. So what they are invested in more heavily is venture capital, which we use in our strategies, leveraged buyouts, which is private equity, natural resources, of course, real estate at about 10%, and a pretty big part here is in absolute return or hedge funds. Now, for a long time, especially in the first decade of the millennium, hedge funds weren't particularly accessible by retail investors. They may have $5 or $10 million minimums and be limited to institutional investors. That has completely changed in the world that we're in now. Some of the leading hedge funds from companies like Carlyle or the Millennium Hedge Fund or Third Point or Campbell & Company, some of the best track record, best consistent returning hedge funds are now accessible through registered investment advisors like ourselves to high net worth investors, qualified purchasers, sometimes accredited investors with lower minimums. So what's the appeal? So here's the difference between an absolute return fund and a relative return fund. Most of the funds out there are going to be considered relative return funds. So this would be defining success as beating a benchmark. So let's say you invest in a healthcare mutual fund, right? They are going to compare their performance of that fund to the overall healthcare stock index. So let's say one year the stock index is up 10% for healthcare, and this particular fund is up 11. Great, they've outperformed The index, put a check in that box. But the same is true to the downside. Let's say the healthcare benchmark or index is down 16% in a year, and this particular fund is down 15%. Well, in that scenario, they are considered doing their job well because they have outperformed that index. It has nothing to do with positive or negative returns. It's just outperforming that benchmark. So in years when the S&P is down, a mutual fund can still be considered outperforming, which most don't do anyway, and still be down significant amounts. Whereas an absolute return fund or a hedge fund doesn't care about any index or benchmark. They seek to limit losses and generate positive absolute returns over time, no matter what. This is a little graphic that just shows an absolute return fund, which is the light blue, more consistent, less drawdown, less volatility, versus the equity markets, where you're going to have more volatility, bigger ups and bigger downs. The theory is that by avoiding these down years and just having a consistent, more moderate return at times, you're going to increase the long-term returns of the portfolio from not having to recover from the drawdowns. So a hedge fund, again, absolute return, they want positive returns no matter what. They also can go anywhere. They're not limited by a benchmark or an index. So that same healthcare fund that we spoke about, they may have it in their criteria that they can only invest in healthcare publicly traded stocks. And all funds have a different constitution of what they can do, but a hedge fund is different in that they can do whatever they want. They may buy an airport. They may invest in railroads alongside a long and short strategy using bull strategies in the public equity market. So they're really, they're not defined by any one strategy. Typically, most hedge funds will kind of have a guide of what their focus is to generate their return, but they're certainly not limited by that. So here's an example of one of the hedge funds that we use. This is from Campbell and Company. This is a multi-strategy absolute return portfolio, mostly actually focused on equities. So they're using complex equity strategies, short-term momentum, regime capture, enhanced carry, single market momentum, basically any type of equity strategy where they can make money when the market's up or down or sideways. They're instituting to create a consistent return for this fund. One of the common characteristics that you'll see in a hedge fund is a lower standard deviation or measurement of volatility versus the S&P. So I'm going to focus on this, actually let's focus on the 5-year performance of this particular hedge fund versus the absolute return or hedge fund index. Now it gets more interesting to compare this to the S&P 500 because there's going to be years where the S&P 500, when it does really well, is going to outperform the majority of hedge funds. But the important key to a hedge fund is on those years when the S&P 500 does poorly, hedge fund is typically going to outperform. And here we are in early 2023, coming off of a pretty rough 2022 in the market, where depending on what index you look at, the market was down 15 to 30%, and a lot of the hedge funds had their best years ever. So look at the overall absolute return portfolio of this particular fund, 11.6. That's over 5 years. So we know historically the S&P average is about 8. Now the absolute return index is not quite so good, 1.9%. So you have to pick and choose the hedge funds that you invest in, which can be a challenge. You're really focusing on their long-term track record, which this fund has. You can see it's been around since 2002. But it's essentially a blind pool, because if you buy a real estate fund, you can look at a prospectus and you can see exactly what real estate that fund actually owns. It's not the case in a hedge fund. You're turning over your money to that manager and they're doing whatever they want with it. So you're really putting your returns in their hands in a blind pool standpoint. So your job as an investor is just to look at the track records, look at their strategies, and choose the best possible fund or funds for you. And of course, like anything else, diversification is key. But if we look at the standard deviation, 9.7, that's the primary measurement of volatility. The S&P over the last 30 years has a standard deviation of about 15. So we're pretty much at 2/3 the drawdown potential or risk or volatility potential as the S&P. If we go on the 3-year, it's a little bit higher on this fund, 10.4, but their 3-year rate of return is 13.5. So in this particular case, in this particular fund, whether you're looking at the 3 or 5, you have a much lower volatility measurement or standard deviation and a much higher return than the S&P 500 average. And then the drawdown potentials are pretty much the same as the S&P. Historically, the S&P averages 13 to 15%. So these strategies can, and we are using them in our client portfolios from some of the leading hedge funds available that absolutely do outperform the S&P on a consistent basis. They're not suitable for every investor, primarily limited to qualified purchasers with investable assets of $5 million or more. There are some fees that are built into these funds. Of course, any numbers that they're reporting are always going to be net of fees. There's 5 or 6 hedge funds that we've identified right now, most that most investors would be familiar with, that we're including in our allocations. So certainly if you'd like to learn more about how these can play a part in a portfolio with the main goal of reducing asset correlation, a more consistent return, less volatility, and less drawdown potential, we'd certainly be happy to share those with you. Okay, thank you for watching. I hope that this was helpful.